Doug Dachille, he's the co-founder and chief executive at First Principles Capital Management. He manages about $7 billion in fixed income. He's got about 2 decades of experience managing assets for large institutions. I'm not going to hold that against you. All right. So,
and I worked for a bank.
Indeed, you did. Now, you heard the president speak not only today, but in fact, you and I were exchanging some emails late one night about the president's jobs plan. Do you think that this is the right thing?
Well, wait, you had the headline. Bank of America is going to lay off 30,000 people. Okay, now, in that speech, 2 of the things that were discussed were jobs, and the other thing was we were going to help homeowners refinance their mortgages. Well, is that consistent with laying off 30,000 people who could help homeowners refinance their mortgages? One of the issues to helping homeowners refinance the mortgages is we don't have enough people to process potentially all the applications. So we're today, after that speech, we're laying off 30,000 people at a bank where you could probably redeploy many of those people to help restructure and refinance mortgages where there are capacity constraints in the mortgage system to actually do all the refinancings, assuming you could get through the process.
All right, so that contradiction seems very obvious. Why is it not obvious to the people involved in making these decisions, whether it's Brian Moynihan, the chief executive of B of A, or indeed the president, our own chief executive?
You know, let's talk about the issues about mortgage refinancing. I mean, the issue around mortgage refinancing is the problem with the mortgage refinancing plan is there's a major issue about reps and warranties. If you go and do a refinancing of somebody else who originated a mortgage under one of these streamlined refinancing programs, one of the concerns of that new originator, that new bank that's helping you refinance under that program is, well, if the person subsequently stops paying, will the mortgage guarantors, the GSEs, Fannie Mae and Freddie Mac, stick that loan back to me? So everybody's afraid that if they were to go ahead and implement the plan to help a streamlined refinancer, a responsible borrower who's been paying consistently for 24 months for a loan that was originated 2 years ago, and the borrower has paid consistently for 2 years, the new originator who's trying to help you do a refinance, he's afraid that if right after he does that and you default or stop paying, that they're going to come and stick that bad loan back to you. So why would I ever want to do that? The point, however, is those reps and warranties need to be addressed. Otherwise, these streamlined refinancing programs won't be done.
Well, do you need a jobs bill in order to do that?
You don't need a jobs bill. But the other issue that you have is what I found fascinating last week with respect to mortgage refinancings is, which is shocking, and you have to start thinking about the implications to other policy considerations, is as the government started analyzing what are the consequences of these streamlined refinancing programs to help responsible borrowers who have been paying their mortgage just simply lower their rate, one of the considerations was what would happen to the market value of all these mortgages that we bought in the Federal Reserve's portfolio, in the GSE's portfolio, which could cause a loss. Well, that's shocking, because now we're going to worry about the mark-to-market value of portfolios of assets that we own as part of policy decisions. Think about this.
But policy decisions were not supposed to be about making profits. They were supposed to be about helping the actual people in their homes.
First of all, there's 2 issues. The only reason those mortgages are trading at these prices by which there could be losses if you refinance was because the federal government bought these mortgages and drove up the prices. So the intention of those purchases wasn't to create proprietary trading gains. The purpose of those purchases was to lower rates and help borrowers. The investors never expected these prices to ever get there. Everybody assumed the minute rates went down, people would refi. But now we're looking at, oh my God, these prices are at 110, and if we help people refinance, those prices at 110 will go to 100, and we'll lose money in our investment portfolio. If you take it to the extreme, what's going to happen when the Federal Reserve wants to raise rates? Are they going to consider the consequences of the fair value to the portfolio of $1.25 trillion of assets when they decide to raise rates as part of a policy decision? It can't be possible. That's what I've said this many times to you, that human nature is such that you're always going to look at your P&L. And anytime you're holding securities and it's generating substantial amounts of P&L, when that starts reversing, there'll be a natural hesitance to necessarily do the right thing for policy. And we're seeing that in CBO research reports about large-scale refinancing programs that are looking at the consequences of what happens if all these people refi and the bond prices are at 107 and they refi to $100.
Doug, we're also talking about housing and credit, and I want to just bring up something that you mentioned during the break, which I think is very useful to understand. The banking system in the United States is based on making credit available. Credit available for homeowners, credit available for businesses. But it seems as though by the actions of the Federal Reserve in concert with the Treasury Department, they're trying to turn credit into a shareholder gain.
Well, the banking system really serves as the transmission for economic policy. There's economic policy, and, you lower rates and you do QE. And the game plan there is to hope that the banking system transmits that to the consumer. The Fed does not make loans directly to consumers. The Fed gives the facilities, the capacity to do that through expanding reserves. But at the end of the day, you need the banking system to actually get in touch with somebody and make a loan and extend credit. The problem that we have now is it's like all of the banks are being put in timeout by the regulators, not necessarily the Federal Reserve and the Treasury, but the regulators are now. Basel, we saw a statement today.
Right,
Basel,
Jamie Dimon, the head of J.P. Morgan Chase.
The reality is Basel is not discriminating between U.S. banks and Canadian banks and European banks. Everybody's going to be bound by those same rules. Of course, there'll be different rules for different sizes, but at the end of the day, those rules are putting banking in a timeout. They're going to they want to make it a risk-free business. The whole purpose of banking is to take risk, to take credit risk, to provide liquidity to the system, and for doing that job, that task, the banks get access to all of these great government, taxpayer-supported resources. You have access to the Federal Reserve for liquidity. The problem is, in the past, the regulators have been concerned that those wonderful taxpayer-supported facilities of liquidity and capital were abused for the benefit of the executives, the agents of the bank who run them, for their own benefit.
Compensation, high levels of compensation for banking
executives. Take lots of risk, we get the reward, the downside's borne by the taxpayer. The solution isn't to try to shut down risk-taking at the banks. The solution, of course, is to regulate the compensation to make sure the interests of the people who are running the banks are aligned with shareholders, to grow the business and take prudent risks, and taxpayers who are providing all of these wonderful liquidity and risk facilities to the banking system so that loans can be made, liquidity can be provided, executives can make money, and shareholders can make money. That's the issue. Right now, the solution has been, let's basically stop any risk-taking activity to the point where if you want to provide liquidity to a corporation, an undrawn facility. They just want to have a backstop. Maybe I need $100 million, but I'm not sure I'm going to borrow it. Well, now the proposed regulations would be such that the bank needs to assume it was fully drawn instantly right now, provide regulatory capital and liquidity capital one for one. You've completely deleveraged the banking system if that's the way it works. There will be no purpose to banking if you have one-for-one liquidity against undrawn facilities. The whole purpose of the bank is much like NetJets. I have a handful of planes. I have lots of customers. I have more customers than planes. And, of course, if all my customers in New York City want to get out of town, I don't have enough planes there. Well, at least in the banking system, there's a backstop. It's called the Federal Reserve. You tell the Federal Reserve, they get you a bunch of planes over to New York when everybody draws on those undrawn liquidity facilities. That's why you have those facilities. That's why banks play a critical role in liquidity. And that's why the Federal Reserve is doing that. But if you have these capital regulations that say one for one, no leverage, the banking system comes down. There's no credit extension. There's no liquidity extension. There's really no role for the banks to help the economy.
But there is a role for the banks if they're going to end up lending money, let's say, to the U.S. Treasury by buying Treasury bonds.
Right.
The Federal Reserve buys U.S. Treasury bonds. Those are basically IOUs. The Treasury gets some very low-cost funding.
Absolutely. Well,
what does that do for the real economy, though?
Well, we know it. The reality is what essentially has happened is the Federal Reserve has converted all of the treasuries that they bought into overnight money. Essentially, what's now happened is the cost of funding of the Treasury, because the Treasury issues a 3% coupon bond. The Fed buys it. It collects the 3%. What does the Fed pay to finance that? Well, the Fed uses banking system reserves. So it pays whatever rate it credits on excess reserves in the banking system. So essentially, the whole capital structure of the Treasury, the 2-year notes, the 3-year notes, the 5-year notes, the 10-year notes, has all been basically converted into overnight money because the Fed owns those 2-year notes, 5-year notes, and it's basically financing it with banking system reserves exposed to the overnight rate. So, in all those CBO deficit projections, I highly recommend they consider the incorporation of the Fed's P&L so that if you project out and the Fed doesn't raise rates for 2 years, 3 years, 5 years, maybe the CBO projections of the deficit are a lot smaller if you assume zero on our entire Treasury portfolio when you integrate the P&L of the Fed with the cost of funding of the Treasury.
You mentioned the idea of overnight funding, because that's basically what we're talking about. Overnight funding as an issue in Europe and European banks right now. Is that coming to a halt?
Well, you know, I mean, this is one of those perverse consequences of a zero-rate policy in the U.S. I mean, the zero-rate policy in the U.S., you know, why do you hear these banks aren't going to make any money? Well, their cost of funding is as low as it's going to go. The problem is the rates of return on their possible investments keep going down. So you have massive margin compression. So the perverse effect is the Fed keeps lowering rates. Profits in the banks will keep going down because they can't lower their debt costs. They got to lower their earnings. And so what do? They fire people.
30,000 jobs,
right.
Bank of America today.
And then you've got money market funds. A money market fund earns 1 basis point. How much risk do you really want to take with only 1 basis point of wiggle room? So do you really want to lend in the markets to French banks, foreign banks? Probably not.
Greece's chance of a default in the next 5 years has soared to 98%. Let's call it 100%. Prime Minister Papandreou has failed to reassure international investors that his country can actually survive the European debt crisis. And indeed, the tax collectors and custom officials, they went on a 2-day strike today, protesting the austerity measures. Now, to help us understand what a Greek default would look like or what it would mean for us, we've assembled a taking stock think tank. We have Irene Finel-Honigman, a professor at Columbia University, an expert in all things European. Also, Carl Weinberg of High Frequency Economics. He's joining us before he goes off to the core club and dishes some economic dirt there. We've also got Dachille, First Principles Capital Management, with about $8 billion under management. Professor Finel-Honigman, Irene, what would a default by Greece mean to the Greeks?
I think to the Greeks, it would be clearly an enormous shock, because one of the first things that would happen with that, there are 2 problems. One, would the default simply mean that the banks would be nationalized, that basically the country would lose all credibility, that they would, in all likelihood, suddenly have a complete loss of their level of, basically their level of living. They're used at now they have a GDP which is on the average as high as any other country in Europe. Would this suddenly plummet? The other issue is whether they would actually be completely forced out of the Eurozone, and at that point, would they return to some type of drachma again, a new drachma, or going back to some equivalent of the old drachma, and how would that possibly allow them to move forward? The real problem is that they're in the worst possible situation. If they do not default, it looks like they will not be able to get out of this mess. If they do default, they won't be able to get out of the mess because there'll be an even bigger mess.
Carl Weinberg, come in on this. I like this idea. The idea being that if they default, they can't get out of the mess. If they don't default, they can't get out of the mess. Tell me, that sounds like an economist on the one hand and on the other hand. Tell me, what are your positions?
There's only one hand here, okay, and it's a really bad one, okay? When somebody defaults, somebody gets hurt. And the Greek people are going to get hurt by this. Their government's going to be impaired. They're going to lose social services, pension benefits they thought they had. Their government's going to get smaller. It's going to be rough. Banks in Euroland are going to be hit. They're going to lose money. Maybe their capital will be challenged. The European Central Bank, which has been buying Greek bonds to support the market, which holds Greek bonds against collateral for loans that it makes the Greek banks, they're going to get hit. They could fail also. We're talking about, Pimm, 2008, Lehman Brothers all over again, but on a much bigger scale, because if Greece goes, we might lose confidence in Italy, investors might lose confidence in Spain, and then we have a much bigger problem relative to the size of the economy than Lehman Brothers was over here.
Dachille, come in on this.
I have a question. My question is, we've seen other countries default. But what's unique about this situation is they used to have their own currency when you default. So, it's usually pretty simple to default, right? You can just print money. It's much simpler than a default of Lehman Brothers that cost billions of dollars of legal fees to actually have an estate and manage the estate. You don't have that. Normally you just devalue and you had a restructuring and that's how you defaulted. So I guess
the bondholders take a haircut.
Well, and then, and you have assets in Greek banks and you have liabilities in Greek banks. Both sides of the balance sheet just go down. I guess my question is, the uniqueness of the situation where you potentially have a default where you don't have control over your currency. And that's what I would like to understand, like how that plays into a default. What do you think?
Well, I think the first thing is that I don't totally agree with that if Greek defaults, automatically other countries end up in the same situation. I still think that there's a huge difference between the state of the Spanish economy, the ability of the Italian economy to get its act together, which is largely right now more a political problem than a straight economic problem, and the fact that a default perhaps in Greece, although I tended to be very hopeful that this would not occur, but I have, as you know, I've somehow changed my mind in the last few weeks. But if it were to occur, this may in fact be a call to Italy, to Spain, to Ireland to continue to very rapidly, Portugal, to get its act completely together and actually be able to still stay in place. So I still see Greek as one isolated crisis point. One of the real issues now is, in fact, the European Central Bank. And the fact that this is this extraordinary, unique experiment, which is now put into question, whether the entire concept of a Eurozone and basically one monetary policy is still valid. Or are we now looking at a situation where we may be going back to actually a two-tier Europe?
Carl Weinberg, come in on that. What about a two-tier Europe? What about a different currency for Greece, maybe a euro with an asterisk?
Well, it won't happen because nobody benefits from cutting Greece loose. You know, if Greece were on its own and we did have a big devaluation, we'd have enormous inflation in Greece. We'd have the debt burden of the Greek people would go up at an accelerated rate because their debts would be in euros rather than in new drachmas. I've seen this happen in Latin America in the 1980s, and it's not pretty when we get into this kind of a spiral. ECU is really helping Greece survive all of this. I just want to take issue with this notion that other countries won't follow here. You know, first of all, a lot of what's happening is confidence. 10 years ago, the markets financed Greece at the same debt ratio they were financing it at last April, or they were balking at financing it at last April.
Carl Weinberg, I've got to break in on you. I beg your pardon, but I want to thank you very much, Carl Weinberg, high-frequency economics professor Finel-Honigman, and Doug Dachille. Thanks.